Hello everyone, welcome to our webinar today on the IFRS updates and the ESMA priorities for 2022. Our speakers of today will be Hans Everaert, manager with us at Finvision, Sam Verfaillie, one of our partners, and myself, Andres Hannibal. Logistics for the webinar, so all participants as usual are muted. However, if you want to ask any questions, you can address them to us in either the chat or the question box of the GoToWebinar app. We will try to keep within 1.5 hours, so just know that we might go through some slides a little bit quicker. We just wanted to include these because then at the end of our handouts, which you can also find in the webinar tool, you have a full overview of our slide deck there. Any questions you want, obviously you can also post them at the end, and we'll do our best to answer, or we might come back to these afterwards. Just for reference, our Finvision Academy IFRS series, we already had a large part of our IFRS series actually. We posted a screenshot on the left here, where you can find these on our website. So all of these webinars have been recorded. We are currently at the IFRS updates and ESMA priorities. Know that there's another webinar in 2 weeks' time on the IAS33 earnings per share. Maybe just the table of contents for today. We have 2 topics actually related, but also a little bit different. The 22 enforcement priorities. The big topics there, or big divisions, are the impact on the financial statements, also non-financial statements. So the non-financial information is also a very big part this year, and some other considerations. So the alternative performance measures and the ESEF. And second big part, our IFRS update for the coming years and the expected and project plans of the IASB. Now, maybe just a quick introduction on what the ESEFs actually are. It's a term I often use, but I imagine for a lot of you that the name does not really ring a bell there. So actually, the ESEFs are a document or a list of issues and attention points from the ESMA, or European Securities and Markets Authority. So at the European level, our regulatory body is trying to harmonize how the enforcement should be of the financial information. And for this, we have our ESEFs, which is short for European Common Enforcement Priorities. So the goal here is actually to have all regulators in Europe try to chase a little bit of the same topics, let's say. And these common enforcement priorities are made as a list on a yearly basis. So why are these important for you? The regulators will all be performing examinations on a selected number of companies. If you have been chosen as one of those companies, they will almost certainly ask questions on the topics of these ESEFs. So there will be a very large number of detailed questions on the, of course, enforcement priorities, just next to the topics that are material to your individual company, let's say. Also for reference, this is not the first year that there are common enforcement priorities. I went back to 2020 and 2021, just as a reference to also show that those topics are usually not new. It's more of an ongoing theme on disclosure and try to harmonize a lot of these items. So in 2020, you all remember this as the year that the COVID-19 pandemic first came on. There were a lot of priorities related to financial statements, most specifically to IAS1, presentation of your financial statements. A very important consideration here is obviously the going concern assumption. Considering COVID-19 and the interruptions in the supply chains and just general economic activity, this was a major point of focus for each of the regulators and obviously also the auditors. Obviously, there will also impacts from COVID-19 on IAS36, the impairment of the assets, so recoverable amounts of certain cash generating units, but also IFRS 9 financial instruments. More specifically, I believe this was part for the expected credit losses. So as soon as there's a difficult market, this one also becomes very important, which was reminded in the common enforcement priorities. The fourth item with an impact on the financial statements that year was IFRS 16, which had a number of specific items for lessees that had relief from rent due to the COVID-19 pandemic. Obviously, there are also priorities related to the non-financial statements. So mainly, again, impact from COVID-19 for social, but also for employee matters. How did the company handle it? But also more general, the business model. How do you create value in your company? Something that should be explained in the other parts of the annual report, but also a starting focus, let's say, on the risks that are related to climate change. There's a third large topic, other considerations, and here the APM guidelines, something I hope by now you all rings a bell, let's say, the alternative performance measures, which were obviously very heavily impacted by the COVID-19. So the goal there was try to disclose as much as possible, but don't make an EBITDA excluding COVID-19 impacts. It's really hard to quantify these effects into a separate line, let's say. So APM guidelines, they're here to stay. It's always a point of regulatory view, let's say, and a lot of focus on this item. 2021, I'll go through this a little bit more quickly. It's presented in a different manner, but as you can see, again, impact of COVID-19 was very heavily a point of focus. So a lot of, again, financial statement impacts, but also non-financial statement impacts. And again, the APMs or the other considerations related to this. Climate-related matters was actually a little bit broader this year. It also came into scope for the priorities on the IFRS financial statements. So you had to start thinking, okay, climate-related matters, how should we express these in the financial statements itself? Climate change is not something that is specifically part of IFRS, but obviously there's a lot of different standards where the climate change considerations can be expected to have an impact here. Again, expected credit losses important as an after part of COVID-19 that was still going, and a reminder on taxonomy related disclosures, which is partially related to, let's say, the impacts of COVID-19 and very importantly, climate related matters, which will receive a number of specific KPIs for which you are working on a taxonomy there. I think more importantly for today, what we'll be focusing on is actually climate related matters. Again, I know, but last year there was a lot of focus on the IFRS financial statements, the impact the climate related matters might have. This year, the focus will obviously continue to be on the same topics, but additionally also how consistent you are in information between the non-financial information and the IFRS financials. Also very heavily impacted, obviously, is the Russia's invasion of Ukraine. Will have an impact over the whole line, let's say, together with the macroeconomic environment, where we will be giving some more details on later on. Taxonomy related disclosures are again the same, but reporting scope and data quality has been added mainly for non-financial information. And as a last part, before we go on to the IFRS updates, we will again talk on the APMs, but also on the upcoming requirements on the block tagging of the ESEF. So first big topic of the ESEFs is climate-related matters. I think they have split them into a number of different items, so both the impact financial statements and non-financial reporting. I'll go through these, which is basically our content table for the coming slides. But actually, one of the big goals of the ESEF here is to prevent greenwashing. So there's a lot of information on climate matters throughout the whole annual report, but the information in scope, the ESMA specifically mentions that it should include if you have committed to any targets, for example. There's the Paris Agreement. By 2050, we want to be carbon neutral for all companies. But okay, everyone says we're doing our best to try to achieve this goal. The ESEPs basically mention that you have to be way more specific. What are our steps planned? What are our actions taken? Are there milestones we want to reach in a few years or not? So we really need to map out the whole road to the 2050 goal, let's say. Very importantly this year, as I mentioned, consistency with the information provided in the financial statements. If you are mentioning all your beautiful green targets and your milestones and how good and green you are, this should also be reflected in your financial statement itself. For example, when you're testing for impairment under IAS 36, all those commitments and green initiatives, they might have a lot of resources allocated to them. So that should also be included in your business plans, but you should also disclose it as such. So very important. I think a lot of us already make these considerations more on the background. The goal of the ESEP here is really to bring out these disclosures in the financial statements. Just for reference, as I mentioned, climate-related matters were already part of the ESEPs last year. I think one of the key items that were focused on last year then were, for example, useful lives of assets. If you have a plant for production which is actually really polluting, it might be time to reconsider the useful life of that plant and the machines included there. Same goes for expected credit losses, carbon and greenhouse gas emission trading schemes. Those are all very heavily impacted by climate change, and you should really consider to disclose all these assessments and judgments you have made to measure your, for example, expected credit losses. So these will continue to be assessed just as last year. Don't be amazed if there's a question on those from the regulator. As already mentioned, consistency between all aspects of reporting in your annual report. More specifically, the ESEP does mention that we will be looking at judgments and estimates that you have applied in the financial statements. So your key judgments and estimates will be very important because if there is a material impact, you will need to further disclose this here. Obviously, there's a lot of management information in your annual report, but also sources of estimation uncertainty. I copied the definition below there. I think we can all agree that climate change, even if there is no obvious risk as of this moment, it just does bring a lot of uncertainty about it. So it might be necessary to consider that. Very specifically, there are a few guidelines the ESEPs mention. It all boils down to do not have boilerplate information. So be very specific which company are you, but very importantly, in which sector are you? That's already a very important item there. If you have a disclosure, a boilerplate item that says we do not have any impact or material impact from climate change, that's not best practice, let's say. You should include the assessment you have performed and the judgments you have made in order to reach that decision. Additionally, they specifically mentioned the time horizon. So it might be that you don't have any material impact in the coming 10 years, but afterwards, towards the 2050 goal of the Paris Agreement, there could be a material impact there. So really important to build up your argument. If you say you do not have any material impacts, why is that? Also, I think very important here, it is mentioned that all this information on climate change, try to disclose this in a single note. Otherwise, it is spread over the whole document. And to be very realistic, almost no one reads the document from page A to Z. So it's very important that you just have a single place where you put all the information in a decent order. Specifically, A second item they mention is the impairment of non-financial assets, as I mentioned. A number of extra disclosures you might need to bring here for the climate change is, for example, your adapted sensitivity analysis. Just the additional uncertainty might warrant that we tend to go broader in how our discount rate or worst case scenario, let's say, impacts or recoverable values. Another item is again the time horizon. It might be in the short term that we are not really impacted, but we might see decreasing terminal growth rates or just the dependence of fossil energy that is becoming a problem. So even if you do not directly dependent on the fossil energy, one of your suppliers might be, and that might be a problem for the company as a whole, let's say. Obviously, also all the nice targets for which you need to make investments in order to become carbon neutral, these should be reflected. But if they're specific to climate change, they should also be disclosed as part of your impairment testing there. So another item on impairment is maybe also impairment indicators. I think to say it generally, climate change can impact you in a lot of different ways. There might be significant changes or breakthroughs in the market, but also just a change in the consumer behavior, which we see very often now, or just changes in your own plants, because certain plants or methods of production become, they're not obsolete from an efficiency point of view, but because the market will tend to more heavily react on polluting activities. So it might be important to also take these into account for your impairment testing. Another point of disclosures you might need to include is, if you have a phase-out plant, if you have material costs to meet these carbon neutral goals, additional variability, but also, and that's another major point of focus here, I think, you need to include in your explanation how you have accounted for possible climate changes. And this would be either an explanation of how you have included these costs, if there are any in your future budgets, but you might also include this by applying a higher discount rate to account for the additional uncertainty. So even if you do not have any material impact in the short term, these will be important to disclose how you consider this for your testing. I think two last attention points the ESMA calls upon are the provisions and the power purchase agreement. So know that your climate commitments, as you do them, not just because you mention something in your annual report, it's not really binding, but it might be that there's a constructive obligation. So know that all your targets and all your commitments, you really do have to discuss a number of these to see if you need to take a provision there or not. The same attention point for power purchase agreements. Beware if you have any contracts, for example, to upfront buy all the output for a solar park. If you want to have a lot of renewable energy to boost your stats, it might be that you are impacting a number of control considerations, either for IFRS 10 or for the joint arrangements there, but also IFRS 16. If there's a lease there, it might be important to identify it. Priorities related to non-financial statements. I'll give the floor here to Hans, who will enlighten you further on the topic.
So basically, it's key to include there in your transaction plans how you will shift your models. So not only say how that you will change your business model, but also be specific. What are the goals or targets that you establish, and how will the resources be allocated to reaching these goals? The ESMA urges to be important on disclosing those neutrality commitments. Are you really able to reach those, and have you allocated sufficient resources to enable you to reach those? Beware as well to be consistent between, again, as said by Andres already, your budget plans you use for your impairment testing and what you disclose here in how you will reach your goals and your targets and how you disclose that. Another attention point, make clear differentiation between greenhouse gas emission reductions from your own value chains and how you would attain contributions occurring outside of the value chains. There is the real European setup of CO2 restrictions, which has an official market, but there is next to that also other frameworks starting up where you can quantify your greenhouse gas reductions emissions, for example. The metrics and the targets, you should clearly indicate the KPIs and give sufficient explanation surrounding those KPIs on how you will define them, how you will measure them, and what will be the past performance as well as the future ambition. If transition plans have affected those metrics and targets, be clear. Also provide reasons why you were unable to meet the targets and how you will shift your plans to reach them in the future. Also important, the ESMA requests to enhance your descriptions. If you have described them last year, reconsider and check again, are they sufficiently clear? And how you have identified the material impacts and risks. So reconsider each year, each closing. Is the description sufficiently clear on how we have identified those risks and opportunities, or should we enhance them to describe further to enable the readers of your financials to have a correct understanding on the material impacts you disclose as well as risks and opportunities. Moving further to a second attention point of the ESMA, that is Russia's invasions of Ukraine. You will see, and I will go in more depth, but the similar topics are coming back, as Andres already described for the climate-related measure. It's all about consistency between your financial statements and your non-financial statements, and being consistent as well in your disclosures and your business plans, your impairment testing, and so forth. Also, again, and it comes back later on, is the relation with the APMs. Just as was the case for COVID-19, where the request was clearly not to put every impact on one single line in your consolidated income statement. Similar here for Russia's invasions to Ukraine. If it's pervasive, do not put it on one line in your income statement. Let it be fully reflected in your income statement and your balance sheet, statement of financial positions, but foresee one note where you clearly describe the full impact on your financial statements with a reference to the specific lines that have been impacted. I think that's the key message that comes back for all of the different attention points. Being a bit more specific, we refer back at the ESMA priorities of 2022, refer back to a separate statement they made already in May 2022 related to the half-year financial statements. They're basically repeating the same attention points now for the full year annual financial statements. So 4 different topics to consider is the presentation of the impact. The second one relates to the loss of control, joint control, or the ability to exercise significant influence. The third one relates to discontinued operations, or IFRS 5. And last one is impairment of non-financial assets. Let's go them in a bit more detail. So when it comes to presentation of the impact, the ESMA requires you to be cautious, as said, not presenting everything on one single line, but rather have a note where you describe in qualitative and quantitative information the significant impacts on the different line items in your financial statement, being statement of financial position as well as the comprehensive income statement. Also disclose any judgment and assumptions applied in recognition or measurement, and also regarding to presentation of assets, liabilities, and profits. Further significant risks of material adjustments have to be updated accordingly. If you have made assessments in prior year or at your half year condensed interim financial statements, reconsider, are they still relevant? Russia's war against Ukraine has evolved in the meanwhile. It is clear now that it will last longer than was expected by many of us in May or June, for example. So that would impact the judgments or the estimates you have made in your condensed interim financial statements at June 30th, which might require a change when you're preparing your annual financial statements of 2022. Also related to that, the major sources of estimation uncertainty might have changed as well. Important is to consider as well your disclosures in respect of sensitivity, especially if you had sensitive assumptions disclosed already in your 2021 financial statements. Given change in circumstances, these might have changed and might have become even more relevant because the sensitivity range might need to be extended, which again requires disclosure of the key assumption there. So be aware to reconsider them and to see, should we extend our range or should we change the key assumptions compared to what we did in last year. That not only relates to the discount rate, on which we'll come back later on in the macroeconomic environment, but also your cash flow estimations should be considered given changes in circumstances as a result of Russia's invasions to Ukraine. Disclosures regarding judgment, significant uncertainties, and going concern should be considered. If needed, reconsider your ability to continue as going concern. It's important to say there for consolidated financial statements that such assessment should be made at group level. So it might be that one of the subsidiaries cannot consider a status as going concern, but the whole group still can be considered as going concern. So you should make a distinction between that assessment on a subsidiary level or an entity level and at a group level. Other disclosures that could involve changes in judgments or uncertainties could be deferred tax assets you recognized in the past might not be that certain anymore given change in the business or restrictions not allowing you to realize or quickly enough your deferred tax assets. Impact on fair value measurements you made. The need to recognize provisions or to consider onerous contracts. Remeasurement of your foreign currency and also in an insurance sector, insurance contract liabilities that might have changed. Second attention point in view of Russia's invasion in Ukraine is the loss of control. The ESMA noted in half year that a number of companies and groups are considering the loss of control, also because of the restrictions that have been imposed during 2022. Important there is to consider, do you really meet the criteria set by IFRS to say that you have a loss of control or a loss of significant influence or a loss of joint control? Attention points there. What has been noted that in a number of situations, call options to buy back shares or deferred payment have been included. So the impact of that on the assessment, whether or not you have lost control, should be considered. Other clauses that have been noticed are the clauses that foresee a continuing involvement by local management that could indicate that there is still a control or at least a significant influence available. So in your disclosure, you should provide sufficient details that enable readers of your financial statement to understand how you came to the judgment or the assessment that there's a loss of control or not a loss of control. That could relate to who is the buyer, situations where local management is buying the subsidiary in Russia, but there is a clause to buy back the shares at any moment, or even a put option by local management could clearly impact the assessment that there is still control. Also, the main characteristics of those call options are required to be disclosed if they influence your judgment or your assessment made. Call options to buy back shares might fall under the scope of IFRS 9 and should potentially be considered as a liability under IFRS 9 at fair value, where changes subsequently should be recognized in your P&L. So, moving further, any changes in fact and circumstances might limit your rights to be exercised because of restrictions that have been imposed. However, simply a decision to abandon operations might not necessarily lead to the loss of control. So you might have taken the decision to abandon the operation, but still have control, which at that moment should be considered and applied correctly as well. Moving to discontinued operations, there is the guidance of IFRS 5 that clearly says that you should apply it if you have been disposed or it is classified as held for sale. And it relates to a major line of business and is part of a single coordinated plan. So there is a number of criteria to consider in IFRS 5 that should be applied to if you want to separate them as held for sale or discontinued operations in your financial statements and in your comparative financial information. If you apply that, provide transparency on the judgments you made that came to the conclusion why IFRS 5 should be applied. Once you have concluded, be sure to be consistent between the information included in your financial statement and in the different management report or ad hoc disclosures that are reflected. Other things to consider resulting from Russia's invasion in Ukraine is assessment and scope of your impairment testing, whereas in last year some were considered not to be in scope given change in circumstances that could result in the need to perform an impairment testing. One of the examples could be gas supply restrictions or potential rationing of energy that has been announced, which could impact the need to have an impairment testing done. If you do impairment testing, make sure to consider various scenarios and also disclose eventually the key assumptions of those scenarios considered. If you have decisions to abandon or dispose or suspend operations, make sure to take those into account in the preparation of your business plan and the assessment whether or not an impairment or a write-down would be required. For associates and joint ventures, know that the impairment indicators that require you to do an impairment testing are reflected in IAS 28, paragraph 40 and 41. If you come to the conclusion that there are impairment indicators, then you should apply IAS 36 in the impairments testing to be performed. So there is a small different matter to consider there. The impairment indicators refer back to IAS 28. If you come to that conclusion, go to IAS 36 and perform an impairment testing. Be careful in the assessment of cash flow projections. As said before, consider sufficiently different scenarios to have a reasonable, supportable, and realistic estimate, and be consistent. Cash flow projections and assumptions used, and any changes made in your strategic plans should be consistent between the cash flows used and the underlying assumptions. Moving to discount rates, and it will come back later on in the overall change of macroeconomic environment, because obviously both are linked a bit. Consider the current market assessments in the time value of money, and also the risk specific to the asset being tested. Whereas clearly, if related to Russia or Ukraine, the specific risk might be higher than in another environment. Make sure you don't have an overlap. If you consider them in your discount rates, then you should not consider them in your projected cash flows and vice versa. In any case, always the ESMA expects you to be clearly to provide sufficiently clearly disclosures, give explanation not only about what has changed, but also why it has changed or how you came to the judgment, and then the key financial and operational assumptions you made or changed compared to prior year. Other matters to consider is the expected credit loss. Do your ECL models clearly reflect all forward-looking information that you have available for example, your clients in Russia or Ukraine? It might not be only those two countries, but also beyond, because your clients are impacted again on their side by what is happening in Ukraine. And also consider, are the credit enhancements, for example, financial guarantees provided, still relevant and available? It might be that a non-Russian client of you is getting a financial guarantee of its Russian mother. Given the restrictions, is that mother still available to provide that guarantee, or should you consider that the financial guarantee is in practice non-valid, so you don't have such a guarantee to consider? For hedge accounting, if you're applying hedge accounting, you might need to reconsider your hedge accounting relationships, and if there is less highly probability, more of the impact could end up in your income statement instead of going to OCI directly for a highly probable hedge accounting relationship. Again, disclosure for everything what was just described, but also if you're talking about your liquidity or your credit exposure, you might need to reconsider or extend the disclosures you made required by IFRS 7. Hedging activities was just referred to on the impact of applying hedge accounting, but it could also be required to extend your disclosures regarding your risk hedging activities. If you're using derivative financial instruments, the increased volatility we've seen in the financial markets in the last months could result in triggering aspects of your contracts, resulting in higher significant cash outflows resulting from margin calls. So also there could be an impact of Russia's invasion in Ukraine. We have an example already here this is Renault Group that clearly announced in their half-year financial statements, so it's not a full year, but it's a half-year financial statements at June 30th, 2022. Their announcement was made to sell off their investment in Renault Russia and the Avtovaz Group. They've indicated that the impact of this consolidation in one single note, B3B, and also further off of balance sheet commitments and contingent liability. They clearly also mentioned the buyback of its investment in some circumstances. Moving further, they provide further information here where they give some further impact on what is all resulting from that potential impairment, determination of restructuring provision, and risk associated. Also indication regarding IFRS 5 and how they came to the determination. In the part of estimates and judgment, principal estimates regarding climate issues, something Andreas already referred to, are mentioned because clearly the Renault Group is also impacted by climate-related matters, which they further describe in that part here. And then changes in scope of consolidations. There is the note 3B, which describes the discontinued operations in Russia, resulting in comparative information that is restated as well, and also further information in the assets held for sale. So this is one of the examples which makes a clear reference and also a separate note regarding that. This example where we put in some highlights to make it easier for you have been included in the downloads available for you. What is the impact? And one of the other attention point of the ESMA is the changes in the macroeconomic environment. Obviously, there is overlap with the topic we just discussed, but the scope might be different, whereas for some companies, Russia's invasions in Ukraine might be more relevant in their assessment. For others, the impact of Russia is less big, but given the overall change in the macroeconomic environment, that still might be relevant for those groups. What is brought forward there by the ESMA as attention points for different topics, but key is assess and reflect the impacts of changes in the macroeconomic environment and uncertainties will have on your financial statements. And once you've done that, provide clear and detailed disclosures that allow your investors to have a relevant, accurate, and timely understanding and information available. Let's dig into 4 specific subtopics. The impairment of non-financial assets. The ESMA expectation is that the increased interest rates and uncertainty will have an impact on your discount rates you apply in your impairment test. Comes back to what we discussed earlier, and get the high price volatility, for example, on your commodities, might bring additional volatility as well to consider. So make sure to have your disclosures sufficiently granular, which might be needed more granular than was the case in prior year, and also make sure you assess what are now the key assumptions. Are they similar to last year, or does the change in the macroeconomic environment result in different determination of your key assumptions? That could be in current year of cash flow projections, your terminal value, or your growth rate. Make sure also to apply those changes consistently, not only on your revenue, but also on the cost of production. So you might be faced with an increasing cost of production. Consider as well, is the company in the specific market they're operating able to pass these high costs on to their customers? Whereas in some environments, that will not be an issue, or they will even have an opportunity to have higher margins. For others, it will be vice versa, and it might be difficult to pass on the increasing costs fully to your customers. Particular attention points: make sure any potential indication of impairment is identified and act upon timely, and also make sure that subsequently you assess what are the key assumptions. Explain what the impact is of your interest rate you applied in your impairment testing, and also consider adjustment in the range of reasonable changes. So the ranges might need further broadening this year compared to prior, simply because of the change in the macroeconomic environment. In your employee benefits, the actuarial assumptions should be reflected correctly. The increasing interest rate is obviously the first one, which has a positive impact, I would say, because your employee benefit liabilities will decrease as well. But the ESMA indicates as well, it's not only the discount rate that should be considered, also consider what are the expected future salary increases, which obviously will increase further, especially in Belgium with the automatic indexation, that will have a negative effect on the estimated employee benefits. Revenue from contracts with customer. If you're recognizing a contract asset, make sure you consider in the context of strong inflation, what will the cost be needed in context of rising prices of material? Whereas in the past, this could have been lower given increasing costs and then the recurring impact of high inflation, it might be needed to reassess the cost needed to fulfill your contract. Also is the expected credit loss, as was the case for Russia's invasion in Ukraine. In the overall macroeconomic environment, you should consider what is the impact on my expected credit loss model, and what is in my sector, specifically changes that need to be considered. Any changes, make sure you provide sufficiently detailed disclosures on where are the risk concentrations for your group or your company. It's important that you should know that reclassification of your financial assets are only permitted when you change your business model. And once you come to that conclusion, you should apply it prospectively as from the reclassification date. So the triggering aspect here is the change in your business model that could result in a reclassification. I hand over the floor to Sam, I think, who will guide you further to changes and attention points in the taxonomy related disclosures.
Thank you, Hans. We talked a lot about the financial statements, but the taxonomy-related disclosures really relate to the non-financial part of the financial statements. What we call also, and where we go through is integrated reporting, including financial statements and non-financial statements together in one report. The taxonomy is an initiative of the EU. The EU has issued some regulations. Can we move the next slide, Hans? Has issued the taxonomy actually helps us to understand and to classify the activities and the actions that companies are taking with regard to the objectives, the environmental objectives that were issued, and there were 6, but that I will come back later. The main taxonomy regulation is Article 8, and it talks about the non-financial undertakings, and it helps us to what is really sustainable. It will help us to define what is sustainable, and the EU taxonomy provides, like I said, the unified classification system. The scope of the taxonomy regulation includes undertakings which are subject to certain criteria. Mainly, currently, it's only public entities who are quoted, public entities who publish consolidated or non-consolidated financial statements, or public and meeting, for example, with FTEs more than 500. Know that this will be changing. Now, in 2024, there will be a new directive issued, hopefully, or will be come into force. And that will require not only public companies, but also private companies. The scope of the taxonomy will be reduced significantly, will be enlarged significantly for companies. So also private companies will need to include certain disclosures about environmental aspects and also apply the taxonomy. This was first done in 2022, and the 2022 financial statements, there were for the non-financial undertakings. These are the non-financial institutions, for example, not insurance companies, not banks. They had to require disclose taxonomy eligibility, but for the annual report 2022. They will also have to disclose the taxonomy alignment versus the climate change mitigation and climate change objectives, which are 2 of the 6 climate environmental objectives that the EU has defined. The taxonomy, Article 8, specifies certain KPIs. The KPIs, non-financial, for each sector, also for financial, there are different KPIs defined. There are 3 KPIs that you have to report on. As from already last year, but certainly as from this year, it's about turnover KPI, the capital expenditure, and the operating expenditure. And those KPIs, you will have to align to determine which percentage is related to eligible taxonomy activities and which percentage is related to aligned taxonomy initiatives. And you will have to provide a lot of extensive information, qualitative information, how you have defined the KPIs. This is also defined in the directive with examples, but you will have to explain it also qualitatively. Also, the methodology for the reporting will have to be explained. This is a general catch-up of the taxonomy regulation. I don't know how much you're familiar with. It is non-financial, but what we see is that the financial departments are quietly involved also in this part, together with other departments, other people, external experts in preparing the reporting for non-financial environmental activities that the company is doing. Like I said, taxonomy eligible, this was required already last year, but the taxonomy aligned is required for this year. And what is taxonomy aligned? Eligible is those that may meet the environmental objectives, and irrespective of whether they meet all the criteria. They are eligible activities that are eligible to meet one of the environmental objectives. Taxonomy aligned is that there have to be criteria met. The criteria met is that they have to contribute substantially to one or more environmental objectives. If they're eligible, they can contribute, but there can also be negative effects that reduces significantly the contribution to the environmental objectives or to other environmental objectives. Aligned means it needs to be substantially to one or more environmental objectives aligned. Also, it does not significantly harm any of the other financial objectives. That's a very important one. And also it needs to comply with the minimum social safeguards. Those items, if you know what does it mean, you can look, there's the EU Compass. I think if you go to the next slide, Hans, the EU Taxonomy Compass helps you a lot by sector, defining activities and how to understand those criteria. I took here an example, it was a nice slide from the ESG reporting of Euronav, which is quite extensive. And there you see the 6 in green, the 6 environmental objectives of the EU. For the moment, only 2 of them, the climate change mitigation and the climate change adaptations, are into force. But you need to meet the criteria, which are the vertical lines, substantially contribute, do not significantly harm, and comply with the minimum safeguards. That being said, I think we can talk, have a separate webinar on ESG and the taxonomy regulation and everything what is required. The ESMA recognizes that this is becoming more and more important, and recognizes also that as of annual reports FY2022, we need to include the disclosures for the taxonomy aligned items. So it's mandatory, but what the ESMA says, it's a mandatory use to use the templates in Annex 2. So they would expect these templates, the same form, not the same form with the same columns and lines. If you go to the next slide, Hans, there's an example of this, what it means. So you see the taxonomy eligible activities, which all the 6 objectives with substantial contribution, and there will be percentage. You have to do that for the KPI of turnover, for CapEx and OpEx KPI. So this is what they expect to see in the reporting, the annual report of 2022. If we go back. So what is important, ESMA says, make sure you don't, it can be that certain activities contribute to multiple environmental objectives, but it cannot be more than 100%. So you have to define it, so it can only be 100%. You cannot do it at 70% to environmental objective 1 and 70% to an environmental objective 2. That's not possible, for example. Always maximum 100%. Aggregation of eligible and non-eligible activities, always 100%. Disclosures, they are not subject to materiality, meaning if we're not doing a lot, we don't need to do it. No, they expect always disclosures about this. So there's no materiality assessment with regard to, do we include disclosures? And also include a lot of quantitative information with contextual information about, for example, the economic activities, how they are, what's the methodology, assumptions used, etc. And then also, they request quite some transparency. Transparency means documentation, explanation, information about the methodological choices that have been applied, judgment and principles. Actually, it's not quite different to the judgment and estimates that you document in the financial part. They would expect this also in the non-financial part. And also consistency, but that was already said by Hans and Andres in the previous slides. Okay, and then finally, not finally, there's the 6th topic also, but also the reporting scope and data quality. There they say the scoping for the non-financial part need to be at least the same as for the financial part. If there are exclusions, you need to explain it, why. So they expect if there are exclusions, for example, a certain business unit, business line, country, entity that has not been covered in the consolidated KPIs for the taxonomy KPIs, they expect to explain that. They also expect to disclose information about the risks linked not only to your own operations, but also to the business relations you're working with. And that means the contractors, suppliers, customers, etc. And also meaning that you will have to look to not only to your value chain or your supply chain also to determine what is the impact and what may be the impact. And there's an encouragement to use even a larger perimeter than the financial scope that you use to provide material information. That's what I said about supply and value chain of supplier and contracts. Okay. And then also they expect that they say, well, the systems and the methodology that you will be using and the process that you have will be very key. So they will expect that there will be internal controls in the whole process in determining the KPIs, turnover, determining the eligible taxonomy activities, the aligned taxonomy activities, etc. That there's sufficient due diligence performed, and this is also documented or explained in the annual report. Okay. And then I give the word back to Hans or Andres.
What are the expectations regarding the APMs and reconciliation? So similar as was, and we said it earlier, in COVID-19 or Russia for half year, make sure it is allowed to have alternative performance measures, but be consistent with them. So the ESMA is not a big fan of APMs, but if you apply them, use them consistently. Don't start adding much more new alternative performance measures because of Russia's war in Ukraine that affects your business, or, for example, climate-related matters. Provide reconciliation. So they expect if you use them, comply them with the guidelines. If you use them in your subtotals, then the disclosure requirements apply. And provide reconciliations. Clearly indicate what are, how have they been defined, what is the definition of those alternative performance measures, and link them back to your financial statement line items clearly. So the definitions as set, and then consistent over time. Don't be cautious making adjustments or including any new APMs.
Okay, and then we have for the ESMA priorities, we have a last separate topic. I'll go through it really quickly because we already filled a whole hour in our separate webinar on that. You can find it on our website if you want to have more details. But ESMA does have a specific bullet point that mentions, okay, we do have block tagging, and you need to be careful because last year we already had the tagging of the, or the mandatory tagging of the primary financial statements. In the current year, that also needs to include for 2022 the block tagging of the notes and the disclosures. So this staggered implementation, it's the first year we need to do this block tagging of the notes, but they just want to iterate that there are a number of important differences with how the tagging of the primary financial statements is done. As you might remember, tagging of the primary financial statements had the principle that you need to tag something with the most narrow element possible, or the most specific element. This is not the case. Here we have an illustrative example that shows the block tagging in action. So it's really on a different level of granularity where we will be tagging larger items. But I think more importantly, the granularity and the multi-tagging, it differs from the primary financial statements. So if there are multiple elements applicable, you need to tag all of these elements, hence the multi-tagging. So I think the example afterwards is also copied from our extended webinar on this. Yeah, for a number of your block tags, multiple items will be applicable. So for anything on financial income and expenses, we have disclosure of financial income, of the related expense, disclosure of interest and expenses, but also finance income, finance expense. So you will really need to dig through all more than 250 different options and check, is it applicable somewhere, or is it applicable on multiple parts of our financial statements? So hence the enforcement priority there, you really need to watch out for this one. And I think the second example, also very important to reiterate on the ESEF requirements, is the granularity. So we're talking about tax block tags in the current year. And one of the most important items they showed us in the ESEF reporting manual is you should not be splitting up tables. So if you're tagging a tax block, the disclosure you are tagging should always make sense on its own. So for example, as it shows here, if you have disclosure of finance costs, that's a number of lines in your table. You shouldn't only tag these, but also the headers of the table and also note to finance income and cost, just to provide a little bit of context. It's just a very important consideration you need to make because, for example, the roll forward tables, everyone has these in the annual financial report, but this does mean that you always have to tag the full table, so including all headers and for the different years, both with, for example, the tag for property, plant and equipment, but also for depreciation and amortization expense, because we're not splitting the roll forward here. So just a very quick reminder on the most important items, I think, there for the ESEF. And with that, I think we can continue to our second large part of our webinar here, which are actually the IFRS updates, which will be presented to you by Sam. So I leave the floor to Sam.
Okay, thank you, Andres. So we talked a lot about what ESMA expects, but there's also some work done by the ISB. Luckily, there's no new significant standards for FY22. There are no expected for 23. So that's the good news. There's still some changes, and some changes may be irrelevant. Some changes may be, or amendments may be obvious for some people. And for some of them, they may have a certain impact or give some additional insight. Mainly the changes are very often coming from questions that were asked to the IFRIC, to the interpretation committee, and that the interpretation committee put it on the agenda and they discussed it and they said, well, I think the impact is too broad. We will ask the ISB to amend the standard for that. So let's walk through it. First of all, for those for 22, so this year, which one do you need to consider? I think the first one is one that may have already been considered. It's the amendment on IFRS 16 leases, COVID-19 related rent concessions. I think this should have been already applied. It should have been applied already in the June 30th financials, because it's applicable as from annual periods beginning on April 1. And basically, what has been said, this amendment just says that it applies to payments already due on or before 30th of June 2022. And the first amendment, this was only for payments already due to June 30, 2022. But you all know, and we all experienced that COVID-19 was a little bit longer in Europe or in the world. So that's why they have done this amendment. And basically, what is in general, the COVID-19 related rent concessions is that you do not need to treat it as a modification. There's a practical expedient that you can select not to treat it as a modification and re-estimate everything, but rather see it as a variable lease payment, and that makes it quite a lot easier to apply the changes, the modifications due to COVID-19, rent concessions, not paying for 3 months, for example, etc. But also you need to have expect that there's some disclosures. There will be some disclosures need to be done on this, but you don't need to make the disclosures with regard to estimates, changes and estimates, where you need to. I think it's in 28F in the initial application of IFRS, where you need to give some effects on opening balance sheet and etc. Okay. Then the next amendment is about IAS 16, property, plant and equipment. And this is, I don't know, this is one that may not always have been applied consistently, but it's about we are developing or reconstructing a property, plant and equipment. And it's not ready for intended use, but it's already used for a part and it will generate some sales or some income. And what do we need to do with the revenue, with the cash flows that we have received from generating already some selling items during a period while it is still under construction. And this amendment specifically says that you cannot deduct it from the cost. So the cost that you will add to the construction or to the asset will exclude the proceeds from selling items that were produced while the asset is still being is still not in the location and condition intended by management. So it will be recognized as revenue or as an income in the profit and loss statement. The third amendment is about provisions, contingent liabilities, and more specifically about onerous contracts. The cost of fulfilling a contract. I think this is very semantic here. There were some questions to the IFRIC done about the definition of the unavoidable cost of fulfilling a contract. Those are the costs that you need to consider in measuring the cost of the onerous contract to make a provision. So they have changed it a bit. They're not talking about unavoidable cost anymore, but they say the cost of fulfilling a contract comprises the costs that relate directly to a contract. Because there was also some discussion about direct attributable, for example, which is strange because this is a term that is very often used in other standards. So they give some examples and they say the costs that relate directly to a contract can be incremental costs that you would not have incurred, for example, or incremental cost of fulfilling the contract also, like direct labor and material, but also can include some allocation of other costs that relate directly to fulfilling the contracts. For example, it can be, the most common examples could be, for example, depreciation charge of a machine equipment that is used in fulfilling the contract. So I think this is one that is quite semantic. The IFRS 3 business combinations, there's some technical changes and some references that has been done. The reference now to the latest, to the 2018 conceptual framework, not to the first one. And he also says if you need to identify liabilities in a business combinations, we need to apply IAS 36 or IFRIC 21 for levies rather than the conceptual framework. That's a clarification. But I think the most important element that they know, it was already the case, but now it is explicitly stated in IFRS 323 that although you need to recognize all assets and acquired and liabilities assumed, including contingent liabilities at fair value, the exception is for contingent assets. Contingent assets you will not recognize in the opening balance sheet of business combinations, which is maybe a bit strange because we need to do everything at fair value and a contingent asset also has a fair value. But that's specifically now included in the IFRS 3. So don't include in the opening balance sheet the fair value of contingent assets. Then an important one, and that's happening a lot, you know, in IFRS 9, that's about the annual improvement, the amendments due to the annual improvements for 1820. And, you know, when can I de-recognize a financial liability? When I have refinanced it. What are the criteria? And there's a criteria in IFRS 9 that says, well, there's a 10% rule. The 10% rule is that the terms are substantially different. Terms substantially different meaning we need to de-recognize it. If the discounted present value of the cash flows under the new terms, including any fees paid, net of any fees received, and discounted using the original effective interest rate is at least 10%. If it's 10% or higher, then you have substantially different terms and you can de-recognize. And this will trigger how you need to treat also with those fees, and this may generate a gain or loss into the P&L. But what is the change? It's the last sentence. In determining those fees paid that you can deduct, you only include fees paid or received between the borrower and the lender. So that's important. Other fees paid to another third party, you cannot include it into this measurement. So that's a clarification about the fees that you can include in the 10% test that you do, whether you can de-recognize a liability, a borrowing, yes or no. That's subsidiary as a first-time adopter. That's a clarification when a subsidiary that can use the basically it says that it's about the cumulative translation differences, and you know that when you IFRS 1 apply, there's some options, and you can put the cumulative translation differences at 0. That's D16, the exemptions of IFRS 1A, and they say now for subsidiary that, for example, applies IFRS 1 later than the parent, that the cumulative differences for all foreign operations at the carrying amount that would be included in the parent's consolidated financial statements based on the parent's date of transition. So this is an added. So you can elect to still show other cumulative translation differences other than those that are that you can elect in D16 for a subsidiary. It makes sense because subsidiary is already part of the consolidation of the parent. There will be cumulative translation difference already recognized, so it would make sense to apply this. And then the last one is about, can I include in the fair value measurements in IAS 41 agriculture, can I include taxation? And you need to exclude the cash flows from taxation when measuring fair value. So that's a clarification also. That's 22. So this should already have been applied. Hopefully you have not learned anything new because we're already almost 11 months further in the year. If not, then you know, and there's still 1 month to include it in your 2022 financials. For 23, there's some other changes happening, and they're more maybe also conceptual and may have more an impact on the annual report. The first one is presentation of financial statements. And there's an update of the practice statement. I don't know if you know that, but there's 2 practice statements issued in the past, and that gives guidance that they are not mandatory. The practice statements, they're give some guidance about, and this one, the practice statement 2, is about disclosure of accounting policy. So it's applicable for 2023. And it says, it clarifies, and that's a debate that we see already a lot with preparing financial statements and the accounting policies, and also the debate with the auditors, is that no, we says it's the significant accounting policies that we include. No, they will have to change, and we only need to include the material accounting policies. And what is material? Is the accounting policy, information is material. If information, I think that's the general definition of material, information included in the financials, if it's included, it can reasonably be expected to influence the decisions of the users of those general purpose financial statements. So that's materiality. So, but you only include material financial policies. You can include also immaterial accounting policies, so there's no prohibition to include that. But it cannot be in, for example, you should avoid that those immaterial accounting policies are so extensive that it will make the attention to the material accounting policies away. So it should not obscure the material accounting policy information. So accounting policy information may be material because of the nature of the transactions, even if the amounts are immaterial. So that's also important. You may know, for example, like it was explained about climate, about macroeconomic, about Russia, Ukraine. Today, it may not have a material impact. We don't need to include an accounting policy on this, but the transaction itself can be material, and it can become material in 2023, for example. Then there's an expectation that this would include, the accounting policy would be included. And also, and that's also already said by Andres, is that we need to, accounting policies should be entity specific. Really avoid boiler templates, really avoid, and now it's specifically said also in the amendment, you don't need to repeat the IFRS generally requirements that are generally required. You don't need to repeat that. So only include, you should only include entity specific, which is relevant and which is material into the accounting policies. Okay, they say also, and that's a bit contradictory now, the general boiler template accounting policies can be material accounting policy, when it's necessary to understand other material information, makes sense, but also when the entity is reporting in a jurisdiction where entities also based on an other gap. In that case, it may be relevant, but that's the entity decision to include also those other accounting policies. So that will be, I think, an important one, how we look at, and I have seen a lot of companies already doing quite some effort in reducing the accounting policies, making them more entity specific and really relevant for the reader, and avoiding the boiler template. And these are some examples that are given in the amendment when an accounting policy is likely to be material. And that's when you have a choice of an accounting policy, it makes sense that you disclose that. When there could be a material change in the information of the financial statements, when there's an accounting policy with regard to IS8 accounting policies, estimates and errors, and when the IFRS does not, so there's no real IFRS that has a guidance or an accounting policy for this transaction. So you apply IS8 and you will make your entity or industry-based accounting policy that you need to disclose, and some other examples with judgments, assumptions, etc. This is all material, of examples of being material. There's also a change on the definition of an accounting estimate. I think honestly this will not change a lot. So the board clarifies just that a change in accounting estimate that results from new information or new developments is not a correction of an error. Okay, so you cannot, it's because something we didn't knew at 31st of December 21 and 22, and we are preparing 23, and we realized that the estimate that we done was totally off, but it was based on this information. This is not a correction of an error. It is just new information, new developments that resulted in this new estimate. But honestly, I don't think this was misinterpreted a lot by issuers about that. And then income taxes, that's one, and we have seen also some diversity in practice in this. Doesn't really impact a lot. But it says, well, it's about the deferred tax assets. When there's also assets and liabilities in a single transaction, the best example is IFRS 16, the leasing. And there they say, well, often companies, they apply the initial recognition exemption in IAS 12 and say, we don't recognize deferred tax asset liability for IFRS 16. When you apply the modified approach or the retrospective modified approach on this, because of the exemption. No, they have added, and it's in yellow, the initial recognition exemption does not apply when at the time of the transaction, the difference does not give rise to equal taxable or deductible temporary differences. So it does not mean then you can apply the initial recognition exemption. But if it gives rise, in most cases, this will be the case when you apply IFRS 16 with a modified approach, a new assets equal the liability, equal taxable, deductible temporary differences. You cannot apply the initial recognition exemption. That's for 24. We're a bit almost 1 year ahead now, beginning of 24, and that's maybe an important one, is the classification of liabilities as current or non-current. So this may already impact how you deal with contracts and how you look at it in 2023. But there's some clarification about when can it be current or non-current in certain situations. And they have removed the requirement. There was a requirement that it's only non-current when there's an unconditional right. And they have removed that, the unconditional, and they have referred it to just there should be a right to defer settlement that exists at the reporting date and have substance. That results in the fact that if there would be a circumstance that happens after year end, that may result in that you cannot, that you need to settle with it in current. If it did not exist at the reporting date, then you can still recognize it as a non-current item. And that's also important with liabilities with covenants. And there's quite some borrowings, loans with covenants that you only look here, and that's maybe also a little difference. So the ISB reconfirmed. Reconfirmed means it was already in place, that only covenants which the company must comply on or before the reporting date affect the classification. So meaning loans, and I need to test it only at no, for example, if we would apply it early in 2022, for example, and there's covenants that first time need to be tested on 31st of March 2023, and we tested, financials are not issued yet, and we do not comply it, but they were not, we don't need to comply it at 31st of December 2022. You don't need to recognize your liability as current. It can stay non-current. So that's basically what they are saying. But there need to be disclosures. In my example, you will have to disclose that. So disclose information to help users understand the risks that those liabilities could become repayable within 12 months after the reporting date for covenants that you need to comply with after the reporting date. All right. Also for convertible debt that may be current, there they say you need to, in the assessment for current, non-current, you can only exclude the portion that is equity, that is recognized in equity. If there's a convertible debt and there's a portion that is still have the host liability, but there's still a portion about the conversion feature that is recognized as a liability, you need to include that in your assessment for current and non-current. So only the portion when you have a compound convertible debt item, you will recognize estimate the fair value of the host liability based on current market rates without conversion option. The difference with the nominal amount will be the equity portion. This part you can assess current, non-current, but sometimes when that does not meet the compound criteria, it's not fixed to fixed, for example, then it will be included as a liability, and then this needs to be included also in your assessment for current and non-current. All right, and there's, I think, a last one for 24 is lease liabilities in a sell and lease back transaction. And they have seen some practice there that that lease liabilities and right of use assets in a sell and lease back transaction were de-recognized completely, because when you lease back and it's full variable consideration, you know, in IFRS 16 measuring lease liabilities, variable consideration, you will exclude it. So if it's all variable consideration, my lease liability will be zero, and I will not recognize a right of use asset, and my variable consideration will flow through the P&L, like before applying IFRS 16. You will have to disclose it, however. And they say, well, that's not correct in this amendment. You cannot do that. So you need to estimate what do we retain as a right of use asset based on the sale and lease back. Can be 100%, can be a portion also only. And we need to measure the lease liability, including the variable lease payments for that one, for the item that we retain control then based on the lease back. So the P&L will only be related to the item that you have partial or full, that you have transferred partially or full the control over those assets. So there will be only for a partial or full termination. Okay, so that's important. That's a deviation from measuring lease liabilities that you will have. And then I think we have the last slide. So we're quite good in time. What is happening also beyond 2024? And there's some changes coming. I think we may expect some exposure drafts and some more significant changes to the IFRS standards issued in 2024, maybe, or 2025. So it will not be applicable, I think, in 24, but beyond. And it's about supplier financing arrangement. Typically, what we know about this is the reverse factoring. So there will be some additional guidance coming on this. Rate-regulated activities, IFRS 14. For many companies, this is not applicable, but for example, Elia is a rate-regulated activity. About primary financial statements, I think this may impact quite a lot how we prepare the financial statements and how we present even balance sheet, P&L, what are the first tables that we have, etc. But this is a topic that's already that you're debating on quite some long time. And then another one is subsidiaries with public accountability disclosures. The first four are expected to become at a certain point in time a standard. There have been already exposure drafts issued on those items. Then there's other ones that we expect exposure drafts, normally in 2023, and it's about the tax reform, the pillar 2 of the OECD, that may impact also how we need to look to tax, and that may impact also the financial statements. It's about financial instruments with characteristics of equity, for example, a convertible debt, but will be much broader. It will be about amendments to classify and measure financial instruments. It will be business combinations under common control, for which we currently do not have a lot of guidance about that. Think about a reverse acquisition in a business combination. This is can also be classified as a business combination under a control before and after is the same person. So we switch the acquirer and the acquiree, but also a merger where a merger between two companies, separate two parents, that are under common control. How do we need to deal with that? And then also about goodwill and impairment. This may also may probably impact quite a lot IAS 36 and how we determine goodwill. But this is still for quite some years to go, so you don't need to worry yet about those elements. Voilà, I think we are almost just in time for the update on what ESMA finds important, and ESMA means what the FSMA will find important, and how they will perform their periodic reviews and ask questions to the issuers, and also what you need to know about IFRS. Also about interpretations, there are no new interpretations issued. So there's quite some about the interpretation committee, the IFRIC. There's quite some discussions going on the agenda that may give some guidance on that, but there's no new IFRICs issued. And in many cases, they are either they are transferred to the ISB for an amendment, or they may be not put on anymore on the agenda on that, or they keep discussing. That's sometimes discussions take on quite a while at the IFRIC. Okay, then I would like to thank you, and maybe for the first time a little short commercial advertising that we do about Finvision. But yeah, don't forget, at December 15, we have the last webinar for this year in 2023 about earnings per share. Can be challenging also, how to determine the dilutive earnings per share, the dilutive, potentially dilutive number of shares. And also at the end of the webinar, you will receive a poll, and there's a question about what topics would you like us to be covered in 2023. So it's always interesting to know what you would like to hear or to learn, what would be interested for you. So put some bullets, put just some words on it, what you find important, what you would like to know, and then we can consider that for 2023. So thank you, Anders and Hans also, and see you or hear you at December 15 at our next webinar. Thank you. Bye-bye.